is my celebrate. I come from Europe, Africa is free, all of them is celebrate the God.
Good morning and welcome to the Central Bank of the Bahamas' industry briefing on the package of proposed legislative reform. I'm John Roll, Governor of the Central Bank. I'm only providing introductory welcome remarks, and those will be followed by as well brief introduction from our Deputy Inspector of Banks and Trust Companies, and then we will move into the presentations followed by the discussion. We encourage those of you, particularly if you're joining virtually, to just type in your questions, if you have any, in the chat, and we will collate them, and at the end of the session, answer as many of them as we can. But certainly, be a reminder that there is also a period up until October 31st for us to receive written public comments on the submissions, and as is practice, when the central bank responds to the feedback from public consultations, we publish all of the submissions and comments along with the central bank response so that there is transparency. But your feedback is very, very important. Over the recent years, the central bank has been working to really amalgamate and pull together a series of reforms to the regulatory landscape for our supervised domestic and international financial institutions. And today we are pleased to present the highlight of these over the course of this morning and later this afternoon. This afternoon, for those who are interested in joining in again, there's a more concentrated focus on the credit union sector. But there are some common themes in the package of legislation and proposed reforms. I'll just touch on selectively on some of them. One of them is a focus on strengthening our domestic financial stability framework, particularly insofar as we talk about the safety net for depositors. When we think as well about how we structure the funding, backstop and assurances for deposit insurance, that's also a focus, as well as an emphasis on preemptive planning as regards the resolution framework for banks and credit unions particularly. Another theme is consolidating and strengthening the oversight space for payments and money services in general. And this also will provide an enhanced framework for to push on financial inclusion ideals, as well as to give the central bank the inroads to address, consumer financial protection ideals. We're also focused on, as a highlight, on consolidating and strengthening the enforcement regimes holistically for all of the central bank supervised financial institutions. And I think you will hear a bit about that in terms of how the administrative penalties regime is better situated in the legislative framework. But just to say, as regards credit unions, which are all members of the deposit insurance system, as well as members of the credit bureau, what the central bank is essentially proposing is reforms that would put more emphasis on strengthened governance mechanisms, placing increased emphasis on risk management framework within credit unions, and more oversight, particularly of the recruitment and appointment process for persons who are at the helm of these institutions, either at the board level or senior management. And these sort of reforms are similar to the mechanisms which are already in place for banks. And so while these reforms are being put forward, it is still recognizing that there are some characteristics that are unique to these financial cooperatives that still have to be preserved, notwithstanding the enhancement of the prudential aspect of their operations. Now, in the money services space, there will no longer be a licensing distinction between payment services institutions, and that's the caption under which a lot of the new mobile wallet providers would have been licensed. And there won't be a distinction between how they are licensed and looked at relative to money transmission business services, which, and this is recognizing that there's essentially equivalency between the way these types of businesses operate and the range of prudential oversight that are already applied to them. And therefore, the distinction really is only historical in terms of how they were introduced to the system, and is no longer sensible to keep them regulated under separate places in our existing framework. The reform to payments also address the clarity and mandate that the central bank would need to have in pursuing issues such as access and inclusion to financial products and services in the domestic banking and payment space, especially at the transactional level. These are expected to, once fully fleshed out, to empower the central bank to begin to address more holistically, for example, consumer protection matters as may relate further to fee setting and other practices relating to products and services that are used for payments. And the products and services that we're talking about would be like your savings, checking account, mobile wallet used for payments, as well as instruments such as credits and debit cards that are also used in payments. And so there's work that needs to happen in this space to address a lot of the access and consumer-related issues. Any work in this space, though, will continue to be based on public consultation and informed by international best practices and appropriately tailored to the circumstances that are important for the Bahamas. I should also point out that potential rules, guidance, and regulations to give full force to other aspects of the reforms that will be outlined today will also impact, legislation and outside of just the payment space. So just be mindful of that. But whatever is proposed or advanced beyond today still follows the principles of public consultation and the central bank taking account of public feedback before we advance to any adoption of proposals. There are other principles which also guide the legislative proposals that will be aired, and you will get to hear about them as the presentation proceeds. We are going to be, asking to receive feedback from industry as well as the public in general on these. Bear in mind that you have until the end of October to do so, and we welcome receiving feedback from all quarters. With that said, I want to thank you all for joining the session today, whether you're here in person or you're joining via the webinar link, and we look forward to your feedback and input. Having said that, I will now invite our Deputy Inspector of Banks and Trust Companies to give some introductory remarks as well, and then we will move into the meat of the sessions.
Thank you, Governor, and good morning. As Governor indicated, I am Cherise Saunders, the Deputy Inspector of Banks and Trust Companies in our Bank Supervision Department. And on behalf of our department, I'm pleased to welcome you to today's briefing as well on these proposed legislative reforms that were issued by the central bank in the form of 2 consultation papers at the beginning of the month. As our supervised financial institutions are aware, the central bank and the Bank Supervision Department in particular typically conducts an annual industry briefing during the first quarter of each year to share supervisory priorities, upcoming initiatives, as well as the central bank's policy work for the year. At that time, we also take that opportunity to discuss any relevant legislative updates. However, given the nature of the compendium of legislative reforms currently contemplated, we thought it important to hold this special session to highlight some of the substantive aspects of the reforms and hopefully stimulate constructive feedback during the consultative period, which ends on the 31st of October. As noted in the release of the papers and as Governor would have highlighted, the proposed legislative reforms are designed to enhance the financial regulatory framework, strengthen depositor protection, and improve overall the resilience of the financial system. These continue to be high priority objectives of the central bank. Per the agenda, you'll see that we have 2 sessions planned for today, and our legal team will walk you through the amendments being made to key legislation, in addition to sharing new regulatory frameworks being proposed. Firstly, in the morning session, the focus will be on the general reforms, payment instruments, and the resolution framework for systemically important financial institutions. The afternoon session will provide an update on key amendments to the legislation governing the credit sector, which seeks to enhance the supervisory and regulatory framework for this sector. We will do our best to answer any questions you have today, but we also look forward to your helpful feedback over the remaining consultation period. Again, I welcome you to the briefing and hope you find the sessions both informative and helpful in your understanding of the proposed reforms. With that said, I will now turn it over to my legal colleagues, led by Stacy Benjamin, our legal counsel, Vandira Carey, our deputy counsel, and Narissa Knowles, our assistant legal counsel. Thank you.
Good morning, everyone. As was said, my name is Narissa Knowles. I am the Assistant Legal Counsel here at the Central Bank. And first, I want to thank everyone for joining us today at this briefing on the compendium of legislative reforms. And so I'm excited to walk you through some of the more and some of the few important proposed legislative amendments that impact the financial services sector. So I will be covering 3 key areas across 4 pieces of legislation. The first being the draft Central Bank of the Bahamas Amendment Bill 2025, the draft Banks and Trust Companies Regulation Amendment Bill 2025, the draft Protection of Depositors Administrative Monetary Penalties Regulations 2025, and the draft Central Bank of the Bahamas Administrative Monetary Penalties Regulations 2025. So my goal isn't to just read through the paper, because of course you can do that for yourself, but I do want to help you understand some of the changes that we will be proposing and explain to you why those matter. And of course, what we are proposing for these amendments and legislative changes are to, inter alia, strengthen the central bank's supervisory powers, broaden access to financial services, and revise the legislative framework for the enforcement of administrative monetary penalties. So I'll start with the draft Bank and Trust Companies Regulation Amendment Bill 2025, or the BTCR Amendment Bill for short. So the key objective here is to introduce and modernize agency banking, also allow for bank and trust companies to appoint agents to provide payment services, and this will ensure central bank oversight as well as accountability for financial institutions. So let me show you how we propose to accomplish these 3 things. So clause 6 of the draft bill deals with appointment of agents. And what Clause 6 does is it repeals and replaces Section 11 of the Principal Act to allow for bank and trust companies to offer payment services via an agent. So if financial institutions wish to offer payment services via an agent, they can do so first with written approval by the central bank. That application itself must first include prescribed information and references. And of course, the central bank will assess that application against regulatory standards before approval is granted. Clause 6 deals with these three main points. I'll move on to Clause 7, which speaks to liability of banks and bank and trust companies. So what Clause 7 is doing in the bill is it's repealing and replacing Section 12 of the Principal Act to make it explicitly clear that bank and trust companies are to remain responsible for the acts and omissions of their agents. So as long as those acts and omissions of the agents deal with the business of the bank or the bank and trust company, even though you allow for payment services to be utilized through an agent, the bank or bank and trust company will remain liable and responsible for those agents. So what this does in practice, it reinforces that delegation doesn't reduce accountability. The accountability will remain with the bank and the bank and trust companies. And of course, as what we are attempting to do is to, as service in this space expands, again, the accountability and consumer protection still remains. So to sum it up, the BTCR amendment bill does two things, basically. It introduces the framework for agency banking. It expands financial inclusion through expanding customer access, and all of this will clearly keep liability with the bank and trust companies to protect consumers. I'll now move to the draft Central Bank of the Bahamas Amendment Bill 2025. So the Central Bank Amendment Bill, for short, does three main things. It first introduces a two-tier penalty system. It introduces a new category, namely small supervised financial institutions. And it also provides needed and necessary clarity on terminology, specifically for violations and enforcement. So I'll start off with the first two, that is the introduction of the two-tier penalty system and the new category, small supervised financial institutions. So this is dealt with in Clause 21 of the bill, and that deals with penalty tiers. So Clause 21 amends Section 47 of the Principal Act and introduces two tiers of maximum penalties for late filings. So the first tier being for the newly defined small supervised financial institutions who will have a maximum penalty of $1,000 for late filings. Of course, the bill also defines who are small supervised financial institutions, and they are namely trust companies authorized for limited services, such as those that conduct trust business with specified persons only, or for those who offer nominee services only. Secondly, registered representatives. Thirdly, cooperative credit unions. And lastly, licensed payment institutions. That's the first tier, okay? The second tier would be all other supervised financial institutions outside of those four that I just named, and they will have a maximum penalty of $10,000. And finally, the $250 per diem penalty is retained, and that still applies. So it's a $250 per diem, $250 per diem penalty that will still remain. So what this tiered approach is doing is ensuring proportionality. So you have two categories, and the penalties for each category will be proportionate to their size. I will now go to clause 22 and 23 that provided the clarity on certain terminology. So this clause makes consequential amendments to sections 48 and 49 of the Principal Act to standardize terminology, specifically replacing words like contravention with violation. And so why is this important? Why does this matter? It makes enforcement language consistent across the Act, and it reduces confusion and helps the institutions to better understand compliance requirements. So in other words, nobody should be left guessing what the terms mean, what counts as a violation, and how it will be handled. So in summary, the Central Bank Amendment Act does two main things. It introduces proportional penalty tiers, and it clarifies enforcement language. So I'll now finally go to the administrative monetary penalties regulations, which have two AMP regulations now. So these include the Central Bank of the Bahamas Administrative Penalties Regulations and the Protection of Depositors Administrative Monetary Penalties Regulations 2025. So the goal of both of these is to expand and standardize the AMP framework across all supervised financial institutions. So let me start off with the Central Bank AMP regulations. So by way of background, just a very brief history lesson. The original AMP regime was established under the BTCRA 2000 Act, whereby the 2016 AMP regulations were introduced. So let's call those 2016 AMP regulations the old AMP regulations for clarity and ease. So under that old regime, the AMP framework only applied to financial institutions that were licensed and approved pursuant to the BTCRA. In 2020, the BTCRA 2000 was repealed, and the AMP framework was placed under the Central Bank of the Bahamas Act. Okay, so that 2016 framework was brought into the Central Bank of the Bahamas Act, and that allowed for the AMP framework to apply to all financial services institutions supervised by the bank. But we want to ensure that that is patently clear. And so what the central bank is intending to do is to revoke that old 2016 AMP regulations and introduce brand new Central Bank of the Bahamas AMP regulations that will make it clear that these apply not only to banks and trust companies, but also to cooperative credit unions and payment institutions. And you'll see that in the new regulation too. That will be clearly stated in the new regulation too, that this applies to cooperative credit unions as well as payment institutions. Regulation 4 now classifies violations by severity. So there's minor, serious, and very serious. Penalties will be scaled to severity, and it will be clear that it will be based on, the violations will be based on who is committing them. So it will be, for example, individuals versus companies. So you will see that violations committed by individuals will be differentiated from violations committed by companies, and you'll see how the penalties are scaled to each class. Finally, Regulation 5 does a number of things. First of all, it distinguishes between late and erroneous filings. It proposes that erroneous filings would no longer attract a per diem penalty, but instead, penalties for erroneous filings would vary based on whether the error was discovered by the central bank or if it was discovered by the financial institution. So I want to make that clear. So if it's discovered by the central bank, the penalty is $1,000. And if it's discovered by the financial institution, the penalty is $500. And so this approach, and we believe that this approach will encourage institutions to self-identify their own errors, and it will foster a proactive compliance. So basically, it will save you money to, establish or report your own erroneous filings before the central bank discovers it in the long run. Finally, the central bank AMP regulations also define what large supervised financial institutions are. Those are banks or trust companies that conduct business with the general public. So we know who large supervised financial institutions are, and we also have an idea of who small supervised financial institutions are. And I will go to now the protection of depositors AMP regulations. So this specific AMP regulations, the PD AMP regulations for short, these fall under the Protection of Depositors Act and deal specifically with deposit insurance, okay? Of course, this ensures that Bahamian depositors are always protected. So what the PD AMP regulations are doing, or what we propose that they do, is one, bring the cooperative credit unions within the ambit of the broader protection framework, and they will be categorized as small member institutions. And you will see their categorization, the cooperative credit unions categorization in Regulation 5. But in Regulation 2, it brings the cooperative credit unions within the ambit of the broader protection, depositor protection framework. Regulation 4, similar to the Regulation 4 of the central bank AMP, classifies violations based on severity. And so you will see minor, serious, and very serious, quite similar to what we just discussed with the central bank AMP. Finally, Regulation 5, also similar to the central bank AMP, differentiates between late and erroneous filings. So I spoke about erroneous filings the last time. Let me tell you what's going on with the late filings under the PD AMP. With late filings, you may attract a penalty of $250 with a per diem of $250 for each additional day of the violation. Okay, so that's what distinguishes between the late filings. There's a $250 penalty and then $250 per day as the violation continues. And that's up to a maximum of $10,000 for large member institutions and $1,000 for small member institutions. And we know what large is, and we know who the small are. So if you're a small member institution, that is cooperative credit unions, it's a maximum of $1,000. And also, as I have here, it will also be based on who discovered it. Okay, if the violation was discovered by the corporation, it will be less, as opposed to, if the violation was discovered by the member institution, it will be less, as opposed to if it was discovered by the corporation itself. So again, we believe that this encourages proactive compliance because it will save you to report your erroneous filings before the corporation discovers. So I'm to the end of my presentation. And so the key takeaways that we hope for SFIs to take away from these new proposed legislative reforms is greater access, same accountability, penalty reform for fairness and proportionality. I think that is very clear that the proportionality and the fairness of the penalties now correspond to the size of the institution. The AMP protection regime is expanded for stronger and more consistent coverage. And of course, it's going to encourage compliance among the SFIs. And also, as always, we want a strong undercurrent of consumer and customer protection. So just in closing, I will just in a very quick synopsis, capture the legislative reforms for these 4 pieces of legislation. Again, the BTCRA amendments modernizes agency banking, introduces and modernizes agency banking while protecting consumers. The central bank amendments ensures proportional, clear enforcement, and the AMP regulations expand coverage and promotes proactive compliance. So we think these changes are crucial. And if you have any feedback, if you have any feedback, you can provide that feedback by the end of the month. And of course, to the policy unit at that email. And if you have any questions, you can use that contact. So thank you very much for your attention. And I'll turn it over to my colleague, Ms. Stacy Benjamin.
Thank you. Okay. Okay, thank you. Good morning, everyone. And my name is Stacy Benjamin. I'm the legal counsel. And this morning I will be focusing on 2 key areas of reform discussed in the consultation paper. So let's get right into it. The first area concerns the legislative reforms that affect the payments institutions and money transmission businesses. And secondly, the reforms proposed in relation to the resolution framework. So turning first to the payments and money transmission framework. The bank proposes amendments to 3 pieces of legislation: the Banks and Trust Companies Regulation Act, and we commonly refer to it as the BTCRA, the Payment Systems Act, and Payment Instrument Oversight Regulations. When enacted, one of the key outcomes of the proposed amendments is that money transmission service providers will now be governed under the broader payment institutions framework, aligning their regulation with international standards for payment services. Currently, the licensing and regulation of non-bank money transmission service providers are governed under the provisions of the BTCRA, which, as we know, is also the principal legislation for the supervision and licensing of banks and trust companies. Money transmission businesses, or MTBs, must also adhere to the provisions of the Banks and Trust Companies Money Transmission Business Regulations 2008, or the MTB regulations. However, as money transmission service providers essentially are offering the same services as other payment providers, the proposed amendments to the legislation will move money transmission businesses into the payments legislative framework of other non-bank payment providers. And this is aligned with global best practices and ensures that these institutions are properly regulated under a consistent framework. To this end, the amendments remove provisions relative to money transmission services from the BTCRA and place them under the Payment Systems Act and the Payment Instrument Oversight Regulations. So, for example, the amendments will remove the terms such as money transmission agent, money transmission business, and money transmission service provider from the BTCRA. while introducing new terms into the PSA, the Payment Systems Act, such as payment services. And that term will be defined in the Payment Services Act as services enabling deposits and withdrawals, as well as the provision of money transmission business. We also introduced the term payment institution, which will be defined as an entity that is licensed to provide payment services like money transmission businesses. Likewise, sections which address the licensing requirements will be amended to allow non-bank money transmission service providers to be licensed under the payment instrument oversight regulations as payment institutions and authorized to provide payment services. These amendments will also expand the bank's oversight powers to include the power to prescribe the standards for payment services and to be maintained by payment institutions, and also to make regulations prescribing the standards to be maintained by payment institutions. As a result of these changes, the MTB regulations that I mentioned earlier which are currently issued under the BTCRA, will be repealed. The transition of MTBs under the payments framework will encourage regulatory consistency, as well as strengthen the bank's oversight of payment instruments and providers to better protect consumers and enhance operational resilience. To achieve these objectives, the bank proposes several amendments to the legislation, which will, in essence, clarify that the central bank's oversight powers include the regulation of any services that enable deposits and withdrawals, as well as the licensing and regulation of electronic money issuers and payment institutions, under the guidance of the Principles for Financial Market Infrastructure issued by the Committee on Payments and Market Infrastructures. The amendments will also update and clarify that the licensing regime under the PSA and the payment instrument oversight regulations include e-money issuers and payment institutions, inclusive of non-bank and non-credit union money transmission service providers. They will also expand the basis on which the central bank may revoke a payment institution's license under the regulations, the PIOR, to include where a payment institution does not meet the conditions of its license or is in breach of any terms or conditions imposed or directions issued by the central bank. The amendments will also strengthen consumer protection measures, which will lead to increased public trust by users. So, for example, the amendments to the PSA introduce an explicit mandate for the central bank to have regard to the interests of consumers when exercising its powers. And lastly, the amendments will also expand the provisions in the PIOR, the Payment Instrument Oversight Regulations, which address the record-keeping obligations and public disclosure requirements for payment service providers, who will now be required to disclose external auditor appointments to the central bank and mandate that external auditors shall be chartered accountants or certified public accountants. So what are the key outcomes and implications for payment institutions? And I've listed 3 for your consideration here. Basically, the proposed changes will ensure consistent oversight and supervision by the central bank and align providers like MTBs with rules for payment instruments and electronic money and other non-bank and non-credit union payment providers, as well as promote safeguards for all consumers. So now I'd like to move into the key reforms that affect the resolution framework. And I've listed a number of reforms here. And basically what these reforms will do will enhance the framework that is already in place. So with the enactment of the Banks and Trust Companies Regulation Act in 2020, the central bank established a very strong legal framework for bank resolution. And that framework was modeled closely on international standards for effective resolution regimes for financial institutions. The deposit insurance legislation, which is the Protection of Depositors Act and the Protection of Depositors bylaws, were also amended in 2020 to further clarify the role of the Deposit Insurance Corporation and expand its coverage to include cooperative credit unions. These current reforms, are part of the central bank's ongoing efforts to continue to modernize the resolution framework, aligning with international standards and best practices. So what we intend to do and what we propose is to introduce further amendments to the principal pieces of legislation that were overhauled in 2020. So the first being the Banks and Trust Companies Regulation Act, the BTCRA, the Central Bank of the Bahamas Act, the Protection of Depositors Act, as well as the Protection of Depositors bylaws. And these legislative proposals are designed to assist the central bank in operationalizing the bank recovery, resolution, and the amended depositor protection regimes, as well as strengthen the resolution frameworks for banks and cooperative credit unions. Now turning to some of the key reforms. First, the expansion of the resolution regime to include cooperative credit unions. So the proposals will expand the resolution regime for banks, which is currently set out in the BTCRA, to cooperative credit unions, which are designated as systemically important institutions. The amendments extend the risk management and resolution tools beyond banks to also safeguard the credit union sector and empower the central bank to exercise resolution powers in respect of failing credit unions, but only those which are proportional to their size, nature, and feature. So for example, one of the amending provisions addresses the appointments of statutory administrators of holding companies and affiliated operational entities, and also resolution tools such as establishing bridge institutions and asset management vehicles. But those provisions only apply to the banking sector, so they will not apply to the cooperative credit unions. However, both banks and cooperative credit unions, which are defined as pertinent financial institutions in the draft legislation, will have to prepare and submit to the central bank recovery plans to restore their operations to acceptable levels of financial and operational soundness, which are reviewed, and those plans are reviewed by the central bank annually. They're also independently reviewed and tested for effectiveness. There are also reforms which touch on the distinct roles for the supervisory and resolution authorities within the central bank. And what I mean by that is the bank itself has dual functions with respect to supervision of the sector and also acting as the resolution authority for institutions that are in trouble. And the reforms also empower central bank as resolution authority with as the resolution authority with broad powers to implement certain resolution strategies. And they also introduce a statutory administrator role for bank holding companies and affiliated operational entities. So just touching on those 3 points, I'll just summarize that the amendments that are proposed will further define, as I said, the central bank's role as the resolution authority, to include identification of the systemically important institutions, appropriate resolution strategy before appointing a statutory administrator. So currently under the BTCRA, the statutory administrator is required to prepare a report for the central bank on any bank which the central bank deems is in trouble, and to which the administrator has been appointed to determine appropriate remedial or resolution actions. In doing this, this may create delays in the resolution process, as the statutory administrator is unable to take immediate action to implement whichever strategy is eventually selected. So to address this, the proposed legislation will empower the central bank to assess the resolvability of systemically important institutions, to determine whether there are any impediments to their orderly resolution, develop and implement any resolution strategies or plans, or apply any resolution measures to troubled institutions which the central bank deems fit, including appointing a statutory administrator of a holding company of a bank, as I mentioned earlier. Also, to ensure continuity of critical financial services, one of the resolution measures that the central bank may also exercise is to appoint a statutory administrator to an affiliated operational entity that performs critical functions or services for the bank. The proposed amendments also seek to ensure that depositors receive preferential treatment and mechanisms to protect public funds during resolution. And this is with respect to the last bullet point here, strengthening safeguards, including depositor preference and flexibility in creditor treatment. So the BTCRA 2020 made provisions at that time for shareholder and creditor safeguards, and to afford stronger protections for creditors and allow greater flexibility in developing resolution options in line with international standards. These amendments will introduce provisions that will give the central bank the discretion to depart from pari passu treatment of similarly ranked creditors, either to prevent contagion in the financial system or to maximize the bank's value. The proposed amendments will also introduce depositor preference that places deposit liabilities in a more senior position than other a more senior position than other senior unsecured creditor claims, and also require an independent valuation of assets and liabilities to inform the central bank's resolution actions. We also have proposed amendments to the central bank's sanctioning powers to broaden those powers to include revocation of licenses for institutions under unresolved statutory administration, and the sanctioning powers of the bank under Section 29 of the current BTCRA will be expanded to include the power to revoke the license of any bank placed under statutory administration that cannot be rehabilitated, or restructured. The amendments will also allow the central bank to appoint a statutory administrator to, as I mentioned earlier, not only a bank, but also the holding company of a bank that's under statutory administration, or any subsidiary of the holding company or bank that provides the services to the bank. And so, as I mentioned before, this is really to ensure that critical functions of the institution continue during a statutory administration. The proposed amendments are also intended to strengthen the framework and operational capacity of the DIC, that's the Deposit Insurance Corporation, by ensuring that Bahamian depositors are always protected, irrespective of the financial balance in the corporation's fund. This will facilitate confidence in financial institutions, the absence of which may lead to preemptive runs from weak but otherwise solvent institutions. To achieve this, the proposed amendments make provision for the DIC to have access to a dedicated, prearranged emergency credit line from the central bank that is sufficient to meet liquidity needs. These emergency funds would be supported by government guarantees and repaid to the central bank from asset recoveries or levies on member institutions of the deposit insurance scheme. The proposed reforms will also place appropriate safeguards on the use of public funding for bank resolutions. So the legislative proposals make provision for the central bank to make advances to the DIC only for the purpose of maintaining financial system stability and supporting a resolution measure undertaken for a member of the Deposit Insurance Fund. In doing so, the government must guarantee repayment in writing, and the central bank must be satisfied that such loans are necessary to prevent systemic risk posed by the failure of a member of the DIC. The proposals also introduce new provisions under the PDA, the Protection of Depositors Act, that will empower the DIC to provide funding to support resolution measures that are undertaken for member institutions as the central bank may determine, while limiting the use of the DIC's funds to an amount it would have paid to depositors in a liquidation and setting a maximum of the existing fund that could be used in resolution. So this is here with addressing the point of expanding the DIC's powers to support the resolution actions and also define permitted loans. The draft amendments to the PDA also make provision for the central bank to make loans, as I've mentioned earlier, to the DIC, and explains what the permitted purposes of the loan must be in which the DIC is allowed to apply the proceeds of any loan. And also use of the emergency funding facility should be repaid from asset recoveries or levies on members. So that is also introduced in the amendments to the PDA. Lastly, the reforms also focus on strengthening the role of the DIC and are also designed to increase the speed, efficiency, and effectiveness of the DIC during the payout process. Proposed amendments will clarify that the decision to intervene and close an institution rests solely with the central bank as resolution authority. The amendments will also remove current provisions that require depositors to file claims with the DIC for payouts, slowing down the claims payout process, and also provisions which empowers the minister to reverse a decision that an institution is no longer viable. So those provisions will be amended and will facilitate a smoother, more efficient, and faster payout process for member institutions. The reforms will also introduce, as my colleague mentioned earlier, the protection of depositor AMP regulations, thereby creating a tiered system of violations by member institutions of the Deposit Insurance Fund, both banks and credit unions, that attracts penalties based on the severity of the breach and also for late and erroneous filings. These changes will make the deposit insurance scheme more operationally streamlined and ensure that compliance expectations of member institutions are clear. So just in conclusion, to wrap up, the aim of the reforms, and there are a number of reforms that we are introducing for both the resolution framework as well as the money transmission businesses and payment institutions. But specifically with respect to the resolution framework, the aim here is to strengthen financial sector resilience while ensuring that our frameworks remain aligned with standards that are internationally accepted. The reforms will create a more flexible deposit protection scheme that is responsive to crisis, enabling the DIC to use funds proactively in resolution, supported by emergency backup funding from the central bank. Meeting these objectives ensures that the central bank is able to continue to meet its key objectives as the resolution authority. And those objectives include maintaining financial stability and public confidence in the stability of the banking system, protecting depositors by ensuring prompt payouts of deposits, and minimizing costs to the public during times of distress. So again, if you have any questions or feedback, we welcome them. I think we're going to go into a question and answer period at this time, but also feel free to submit any questions, comments with respect to the legislation that we've presented this morning and the ones that we will touch on later on this afternoon to the policy unit of the central bank, and the email address is there. You may also call. And so please, as we go into the question and answer period, we just ask that if you have a question or comment, that you come up to the microphone. And I think there are also questions that we will be taking online as well. So thank you for your attention, and I will turn it over to Latoya.
Good morning. Any questions from the audience? In person? No? Okay. So we have one question online, and it relates to the administrative penalty legislation. Is there a rationale for applying an AMP for a self-reported error? If the goal is for the best data quality, wouldn't waiving fees for self-reporting errors be recommended? I would think that it would be in the best interest of the industry as a whole to not charge a penalty for self-reporting.
I think in response to this, like, our motivation really is to not before what, but you do not for what the release report.
Okay, sorry, they're not online, they're not hearing your response, so let me.
Yes, I was saying that I do appreciate the rationale for the question, but I believe the central bank is not acting unlike other supervisory authorities in this vein. We do not wish to support or erroneous reporting or allow for that to continue. Obviously, we want to motivate persons to self-report, and that's the reason for the less penalty if you self-report. But clearly, it is not the expectation or intention of the central bank to support erroneous reporting. And hopefully that addresses the question.
I could add to that. The imposition of penalties and sanction is never just an automated process. So the central bank still exercises discretion in terms of around the circumstances that led to the error. And to the extent that, at the end of that process, you're determining that some sanction is necessary, then the consideration as to whether or who discovered the error, get some consideration. So that's important to point out, because there's no comfort at the end of the day if we're having to identify errors in reporting, regardless of who found the errors, given the use that is made of the information, and often when the errors are reported. So all of those are factors that are taken into account when we look at what has to be done.
Are there any other questions? Okay. And just to be reminded, you also have the opportunity to write in with your questions as well. But if there isn't anything further in the room or online, we can conclude this session and resume at 2 for the session on the the legislation related to credit unions. 2:30, sorry. We will resume at 2:30.
Just a final request for anyone who might be watching the recording of the session. Please also feel free to submit questions that may be specific to what you've seen and heard. Please.
Okay, thank you. All right. So for those in the room, afternoon, everyone. Thank you for joining us again, those who are returning. And for those who are just coming for the first time, welcome. We're going to continue the industry briefing, and in this session, we're going to um, have a focused discussion on the legislation for credit unions. So we'll start some introductory remarks by Governor Roll, and then we will continue with our Deputy Legal Counsel, Vandira Carey, who will walk us through her presentation. That will be followed by a question and answer period as before. We will have an opportunity for persons in attendance in person to ask their question at the podium, at the mic and at the center of the room, and then we will also be taking note of the questions that are coming up on Zoom. So again, thank you and welcome.
Thank you. Again, good afternoon. I recognize some faces from this morning, and I'm glad that you've joined us for the afternoon session. As I'd mentioned earlier, we at the central bank, we've spent some time putting together a collection of reform-focused initiatives targeting the regulation and oversight of our supervised financial institutions. And so that includes the international and domestic banks and trust companies, credit unions, and the money services firms. So some of the reforms, and so this afternoon we are going to have a presentation of the proposed reforms for the credit union sector. And I must say that in getting to this point, we've already had some consultation at the level of the League for the Credit Union Sector. And so this will be an opportunity, not just today, but subsequent to today, to reveal the progress that is made in between the initial drafting and the feedback that we've received on the proposed reform to the credit union sector. But the credit union sector is also impacted by the general reforms to the regulatory framework, which focus on the Bahamian financial stability framework and crisis resolution in its various forms, including the extent to which the deposit insurance is factored in that space, and the safeguards and arrangements that are in place so that the DIC can have a role in terms of how we manage the resolution process for financial institutions and credit unions. I think in terms of specifics for the credit union sector, the Credit Union Act or legislation, cooperative credit unions legislation, is up for reforms, and those reforms will, for the most part, target a range of prudential and governance related issues. Some of the governance issues touch upon the risk management framework that we are advocating for credit union sector, really deepening and enhancing that process. What is also important is the way the central bank as regulators and supervisors interact with the sector. There are proposed reforms that would make that process more direct in terms of the process that the central bank goes through when it's dealing with credit unions from an intervention point of view, to bring it closer in line to the way that process rolls out for other supervised entities. So that's very important. I know we've had, in some cases, some very interesting conversation on that. We're also working with the credit union sector in terms of how the process of senior management appointment, as well as the constitution of the boards, the the consultative arrangement that would be necessary insofar as the central bank is concerned in terms of the persons who are selected and elected to those roles. So I think that too will be a very important one of the reforms that are ahead of us. So this afternoon, we are going to be taken through the highlights of the draft legislative proposals, and we expect that we will get some feedback. But there is a consultation period that goes until the end of October. So we're also anticipating that there will be written submissions. We've gotten good written submission already at the cooperatives level, but this is also an opportunity for those who are members and otherwise affiliated with credit union to also feel free to weigh in because they may not have seen the work that we've done up to this point. So once we have all of that input, it is expected that after the end of October, there would be an internal review by the central bank of the input. And from a transparency point of view, we would typically publish the submissions along with the central bank responses indicating, how or whether those influence any adjustments to the draft proposal. So having said that, we look forward to the exchange today, and we encourage persons who might even be watching the either the live stream or the recording of this event to still feel free to submit questions based upon what they observe over the course of the presentation. So having said that, I will turn things over to the persons from the central bank's legal unit. They will introduce themselves and they will take you through the draft proposals. But again, we look forward to the feedback and any questions or queries that you might have. Thank you.
Thank you, Governor. Good afternoon, everyone. To those present as well as those joining us virtually this afternoon. Your presence is much appreciated as the central bank values your partnership and the partnership that we have with our stakeholders. I am Vandera Carey, the Deputy Legal Counsel here at the Central Bank. And as most of you may know, on October 2nd, of this year, the central bank released a compendium of legislation for public consultation. And that would have included the Bahamas Cooperative Credit Union Act, Amendment Bill rather, and the Bahamas Cooperative Credit Union Regulations. As Governor has noted, this segment focuses on the legislative reforms proposed to these pieces of legislation with an aim to strengthening the credit union sector and the country's financial system at large. Okay. I will cover the more substantial amendments as we would not have sufficient time to capture all of the proposed amendments today, but I can assure you that the consultation paper is detailed and so is the draft bill that would capture every proposed amendment there. I would also ask that you reserve your questions for the conclusion of the presentation. So firstly, we will have a look at the historic timeline. As a way of background, the central bank assumed supervisory authority over the credit union sector in 2015. And this was done pursuant to the Bahamas Cooperative Credit Union Act that was also established in 2015. Since that period, the Act and regulations have remained in place for, you might as well say, a decade without any legislative reform. However, in 2020, the Protection of Depositors Act, that was amended, and it was able to capture credit unions and bring them under the remit of the Deposit Insurance Corporation during that time. But apart from this, no further legislative changes were made until now, and we are now proposing by way of amendments, the Bahamas Cooperative Credit Union Amendment Act 2025. As indicated, there's been no legislative changes, and this has brought about many constraints for the central bank in the execution of the supervisory role that we have. And in other cases, there was quite a number of legislative gaps resulting in a lack of resolution and good governance provisions. And if I may be more specific, the lack of authority to take proactive measures to prevent the failure of a credit union was also at stake. The International Monetary Fund, the IMF, better known as, also reviewed the Credit Union Act and provided recommendations for us. And this would have included the need for the establishment of a resolution regime for failing credit unions, which will include a specified set of triggers for entry into resolution and authorization for the central bank to exercise resolution powers in respect of a failing credit union. However, the central bank also proposes to place these crisis management provisions in the Central Bank of the Bahamas Act, which will capture and relate to credit union sector as well as all of our other licensees. So these resolution amendments have also been proposed in the bill, more specifically. Okay, we will look now at the reform of the act itself. In an effort to modernize and provide flexibility to the sector in terms of how meetings are carried out, the bank proposes an innovative provision that allows for AGMs, annual general meetings, as well as special AGMs to be held either in a hybrid setting or virtually. Now, this may have been the case already for some credit unions, but it needs to be regulated. So that's the reason for us formalizing it here. So therefore, in clause 2 of the bill, you will see the introduction of terms relative to virtual meetings that may be held by credit unions. And we will discuss those provisions later on down in the presentation. Other terms have also been removed and replaced, such as the term order of request that you may be familiar with, and that will be replaced by the term directive. So this will bring about uniformity across all of the legislation that is administered by the central bank. The bank also proposes the introduction of the term audit committee. This is a new board committee, and we will also discuss that later on in the presentation. Thirdly, futile terms that add no value have been removed from the act, such as the term minors. The age of membership is already established as any person over the age of 15. Therefore, the term minor doesn't add any value nor take away. So the term minors will be removed. Okay. You will also note in the bill that there are enhancements made to many of the provisions. An example of one is clause 6, which amends section 14.5 to add an additional 5 subsections outlining conditions by which the registration of a credit union may be canceled. And you'll see here on the slide that some of those include if it appears likely or becomes, if a credit union becomes unable to meet its obligations as they fall due, or if a credit union is unlikely to meet the demands of depositors of the cooperative credit union, or if its continuation in business is likely to involve a loss to the membership, to the members of the cooperative credit union or to the creditors, or in the case of a credit union that is placed under statutory administration. So that would be some of the means by which there can be suspension or cancellation of a license. Facilitation of AGMs. Now, the bill proposes in um, clause 8, to amend section 20, which addresses the facilitation of these types of meetings. And the provision is more prescriptive. It outlines means by which the meetings can take place. So it requires more and better particulars to be included in the notice, for example. So the notice should specify the purpose of the meeting, the type of meeting it is, whether it's in person or hybrid. You should include the virtual link for members attending in that fashion, and just describe whether it's going to be fully virtual or hybrid, etc. Further, it will also advise credit unions not to hold a general meeting virtually unless it is satisfied that every member is able to attend and fully participate in the meeting held in that fashion. Also, you would see that there's now a requirement for the central bank to be provided with notice of an AGM within 7 days prior to the date of the meeting. And in continuation, the new term that I referred to earlier, introduction of virtual meetings. The bank is pleased to introduce this new and innovative measure to provide more flexibility to the means by which these meetings can be held. It is also noted that AGMs, like I said, can now be held virtually, and it requires for members to be considered present if they are attending in that fashion. Also, if there are any documents that will be tabled at the in-person meeting, those should also be provided ahead of time to members attending virtually. It is expected that each attendee is able to participate in the conduct of the business of the cooperative credit union meeting, including the voting process. Each attendee is to be seen and heard, or to be heard by the other attendees in the room. So that should be properly facilitated. Also, there should be effective communication with the chairman or other officers and other attendees during the meeting as well. Communication between an attendee and the chairman or other officers. If there's any failure of electronic communication systems or computer system enabling virtual participation, that would either deprive the attendees, of the ability to participate or identify any other attendees or be identified by the others, would result in an offense. Clause 12 of the Act proposes changes or enhancements, I should say, to the dormant account framework. So there have been some amendments to the dormant account framework. And as you would see, for starters, the current provision, as you know, the dormant period is 5 years. That is now being revised to reflect 7 years. Also, there are new terms being introduced, the term dormant and transactions. Okay, so in a nutshell, the proposed definition of dormant account would reflect a deposit account or other facility at a cooperative credit union where the members has not initiated any transaction for a period of 7 years with respect to a deposit account or any other facility of the member held with the credit union. And the term transaction is defined as an action initiated by a member in person or by electronic or other non-physical means in respect of a deposit account or other facility that such member has with a cooperative credit union and includes a deposit, withdrawal, exchange, or transfer of funds in any currency denomination, whether in cash, check, payment order, or other instrument. Also, a communication acknowledgement, request, or instruction where evidence in writing and signed by the member. or a contemporaneous record of the member's verbal instruction prepared by the cooperative credit union. So the bill proposes also the potential liquidation of security boxes held by members, which may contain precious metals, gemstones, securities. Those may also be liquidated as well. Okay, so this is just a recap of what we just covered. The period has changed and the introduction of the terms. And then instructive provisions have also been implemented for the handling of dormancy and inactivity after a period of time. So those are itemized in the draft bill. Directorship. Okay, so fundamentally, we know that directors have a duty to generally act in good faith and to uphold good corporate governance. Therefore, we believe that the duties of a director are integral to the success of and compliance of the credit union. In this regard, the bill is introducing a few provisions to fulfill these measures. Firstly, the pre-approval of directors. A member who is interested in participating in election to the board must firstly be pre-approved before participating in the electoral process. This also refers to incidents where a vacancy on the board may arise. The bank should be notified and the same process should be carried out before that position can in fact be filled. Secondly, a director may be removed, of course, by membership, so that provision remains. It's been slightly enhanced. And secondly, a director may also be removed now by the central bank. So wherever he fails to discharge his duties effectively or is involved in financial indiscipline or mismanagement or contravenes the act in any way, any of those instances, he may be removed by members by resolution. The bank, like I said, will also be able to issue notice to a sitting director for his removal as well. There's a criteria outlined in the bill by which that can be facilitated. So the bank would then make a decision to confirm, vary, or revoke the notice of removal after the director is given an opportunity to be heard. The power to make directives. Okay, so this new provision provides more ways by which the bank can issue a directive. These directives are evoked in several instances, which include where the central bank is satisfied that a cooperative credit union has failed to comply with a condition imposed or has failed to carry out measures required by the central bank, or it has breached any provision under this act or any other written law, direction of the central bank, or bylaw or written policy of the cooperative credit union. Also, if it is acted or is likely to act in a manner that amounts to an unsafe or unsound practice, or it no longer possesses or is not maintaining a position to maintain adequate capital resources, or it no longer provides security for funds entrusted to it. So any of those scenarios will invoke the power to make a directive. The resolution framework. In response to the need for reform, we have outlined a list of general areas by which the resolution framework would be evoked. Firstly, the appointment of a statutory administrator. This is a new provision under the bill, you would see. And the process for the appointment of a statutory administrator is achieved without court intervention and is able to be actioned whenever the trigger arises. This will allow a prompt facilitation of the statutory administration process to salvage the assets of an at-risk or failing credit union as much as possible. The bill also affords the statutory administrator the accompanying powers that it needs to take control of a credit union and fully manage the day-to-day operations of the credit union. This also vests the statutory administrator with the same powers that a director would have. Management control functions, responsibilities are all afforded under this provision of the Act or draft bill. There have also been some enhancements to the liquidation provisions, as you would note in the bill. The liquidator is also appointed by the central bank. Some of the powers include the right of the liquidator to act as the sole legal representative of the cooperative credit union, assuming all rights and powers of the directors and officers responsible for the management of the credit union. This includes the unfettered access to and control over all books and records, the offices, and assets of the credit union as well. Provisions are being imposed to prevent or to penalize any person for willfully obstructing the exercise of the liquidator's functions. It is also worth noting that provisions specific to measures that can be taken to stabilize a failing credit union will be placed under the Central Bank of the Bahamas Act. Under the current regime, the appellate body, as you know, it is referred to as the Registered Cooperative Credit Unions Appeals Tribunal. We are now proposing that title be changed to the Bahamas Cooperative Credit Unions Appeals Panel. And this body would now be Right, so the league will now be responsible for the appointment of the members to this tribunal. Previously, it was the minister who appointed the members to the tribunal. Clause 28 of the bill seeks to repeal Section 92 of the Principal Act and to replace the section with new provisions which would mandate the Cooperative Credit Union League to facilitate the establishment of this appeals panel. And it would also be responsible for outlining the qualifications for members of the appeals panel. Clause 29 of the draft bill seeks to introduce a new section as well, which mandates the members of the appeals panel to adhere to a code of conduct established by the league. Clause 30 would also outline the process by which the settlement of disputes among members, past members, cooperative credit union and directors, or credit union and credit union would be carried out. However, any appeal that lies with the central bank ought to be brought before the Supreme Court. Okay, we're at the board committee segment, and the bill proposes to restructure some of the committees. Well, restructure in a sense that they will be renamed as board committees. So the nomination committee, for example, used to comprise members solely, but they will now be composed by directors. So after further consideration, the bank is provisionally minded to maintain the supervisory committee as is, albeit the structure is no longer consistent with international standards and best practices. The central bank will still seek to strengthen board level operations by establishing a board appointed audit committee. As conceived in the existing credit union legislation, The supervisory committee is an oversight body with reporting responsibilities to the shareholders. The central bank will also develop regulations to enhance the effectiveness of their role as well. Clause 14 of the draft bill proposes to repeal and replace Section 48 of the Principal Act in order to reform several of the subcommittees, converting them, as I said, to board committees. So the credit committee will now comprise 4 directors. 1 to 2 of them should have experience in credit risk and managing credit risk. And the audit committee should comprise of 2 directors. 1 must be a financial expert, but not a member of the cooperative credit union, among other requirements. But I will note that he must also have recognized expertise in accounting or auditing. The apex body, now take a look at that. Sorry, here we are. The apex body, as we know, the apex body has been functioning in an advisory role, and the bank seeks to enhance the requirements of the apex body to provide more sectoral support and collaboration of the credit unions. This provision also outlines that the apex body should assist its credit unions by providing programs and services to strengthen the sector. And this should look like, we should see more technical advice being provided and shared services and training as that how that however that would look in practice, that should be carried out. Okay, and then just these few miscellaneous provisions I've placed here for our discussion as well. Firstly, the bill proposes in clause 46 to remove the exemption of value added tax. The exemption that's been lifted from the bill. The proposed amendment to Regulation 3. Sorry, no, before we get to the regulations. So we have, like I said, removed the valued added tax exemptions for credit unions to provide fairness across the sectors. Also, the fitness and proprietary provisions have also been removed from the regulations in place into the act, the bill, well, the proposed bill. You would see the criteria there. So it would no longer be placed under the regulations as it is now. Another change is the registration fee increase, as you would note in the draft regulations. That has been expanded and increased because of times of change, and it's been a while since that has been reviewed, so we can discuss it after. It is also proposed that Regulation 19 of the principal regulations, which sets out the fitness and proprietary provisions, as I said, those are now under the Act. Okay. And last but not least, there's been the removal of the restrictions from credit unions, allowing for more flexibility to offer personal loans for longer periods of time and for loans to be amortized over the tenure of the loan rather than it presently is, which is 84 months. Yeah. Okay, so that brings us to the conclusion of this presentation. And I now invite you to present your questions, if any, in person or. Mhm.
Yeah, so before we get into uh, conversation and exchange, I think there's some other clarification that are important. Uh, the first one of them is that there is nothing in the proposed regulatory reform that is a response to any single current or past incident in the credit union sector. Um, we've had some credit unions, very small, even from startup, that were liquidated. Yes, we learned from those, but they do not motivate what we're doing. What what is important to understand is that the difference between a lot of the self-regulatory uh, industry code-based principles that the World Council of Credit Union espouses versus the risk-based prudential uh, framework, which is complementary to the financial performance-driven metrics. But the risk-based framework, which recognizes a lot more um, the environment in which credit union or financial cooperatives operate. It also recognizes that from a supervisory perspective, when you're dealing with resolution, that and you're dealing with how you manage credit unions on a risk basis, on a continuous basis, that the way the regulator interacts with financial cooperatives needs to be look similar to the way the regulator would interact with other financial institutions. And so when we talk about directives and requirements and expectations, it's really just speaking to when something needs to be addressed within a financial institution. You know, the weight or regulatory force that is behind the communication that comes from the regulator looks different than just, a moral suasion driven event. And then also, to the extent that it is risk-based and it is crisis management-based, preemption is very important. And so for every single financial institution, we say, think about how you manage yourself if you encounter an unforeseen crisis. And in this case, we say the crisis could go all the way up to the level where you're likely to fold up and close shop. How do you think about that on paper in terms of how you would resolve that? How do you think about on paper how you might turn it around and get your shareholders, if need be, to recapitalize your operation? Or how do you think about how your operation may be merged into some other operation? So it's thinking about all of those things beforehand so that when you are required to act, you can act, but also to allow you to see where there may be gaps in the way you may be set up. So, so from that point of view, there are some very important principles coming across, but I can say that insofar as prudential and risk-based supervision is concerned, we will still have a gap that we need to close for the credit union sector, and I think that's going to grow with experience. And when I say we have a gap, the gap is also in terms of what is written in terms of the regulations and standards. And so we are going to have to prepare that, over subsequent years, we start to look at what the risk-based principles are and how they can continue to expand alongside the Pearl standards, et cetera, and get the credit union sector moving in that direction. There's one positive that I think we probably didn't speak too much to, but also that we heard what the sector was saying in terms of the cap that they face on the maturity profile of lending. So that is taken out of the existing legislation. But it still then points back to us because it still means that we can do that because we're comfortable when we look at all the potential baselines or benchmarks, we'll know when there's increasing risk or manageable risk, that might be the case, that we can address. So that is very important. And also at the governance level, regulators do not go out there, advertise and handpick who manage financial institutions, whether it's at the board level or at the management level. Those are put forward by the institutions, and all the regulators' role is to see whether the individuals are fit and proper. And if they are competing candidates for a role, that is still a decision that is made at the financial cooperative or financial institution level. So that is very important to understand in the context of the reform. And the other reform is, insofar as risk management is concerned, recognizing that the supervisory committee and its watchdog oversight and accountability to the membership, we can find ways to even empower that more. But some of the reforms are also saying now that the board is also now more directly responsible and accountable to the regulator for risk management. And hence, when you look at the way the audit committee is structured, it is to make certain that the board delivers on it. And I think a part of the dialogue is going to be how, in strengthening the audit committee, do you allow now the supervisory committee also to have a better dynamics? Because a part of what we observe is making certain that the transparency is there, so the supervisory committee sees and has access to what it needs to have access to, so that it can fully deliver on its functions. So those are very important. The dormant account issue, again, that's really just aligning the framework with the way the dormant framework exists elsewhere in the financial system, up unto the level where, after I think 17 years, those claims expire and they typically are escheated to the government. There's a lot more reforms to go on in that space, because what we want to do as well is put in place in the Bahamas a framework where people can actually more effectively query what dormant assets exist that they may be entitled to under some estate, but they have to still demonstrate in that query process that they have a legitimate claim to the assets, but at least make it so that people can make the queries and determine what exists. So that's the reform, I think, that's ahead of us. And to the extent that dormant deposit or deposit-like funds exist anywhere in the Bahamian system, the credit unions would also be covered in that process. So that's something that is also important to bear in mind in terms of the reform. And there's some other provisions like those that, and even when we think about resolution, I think we've had a very good experience already, a very small financial cooperatives in terms of the collaboration between the central bank and the league. When you start to look beyond that in terms of entities that may be systemically important to the credit union sector in the future, if you have to deal with a resolution process, it will look different, because even the financial resourcing implication will be different. But still then, yes, you might have to have that collaborative arrangement. But what this reform framework is sketching really is anticipating that, financial stability, crisis management, prudential supervision, risk-based systems, some of the issues that the framework anticipates, we've not encountered yet, but we have to prepare now so that we can deal with them, and in many cases preempt them, because preemptive is the ideal for us. So from that point of view, I think it's going to be very important to get the sort of feedback. But everyone to understand, we're building a stronger system we're not reacting to some past experience. So that people don't really think about it just like that. We have to be preemptive.
Thank you, Governor, for those remarks. And at this time, I invite you to present your questions, if any.
Public Workers Cooperative Credit Union. I just need for clarity on something. In reading the amendments to the legislation, particularly regarding the retention of the supervisory committee and the establishment of the audit committee, there seems to be a duplication of responsibilities. I just want to clarify if that is true or not, and if it is true, what is the rationale behind having both parties there?
Thank you for your question. Firstly, the bill should show that the supervisory committee's role will remain in place.
Okay.
We have not disturbed any of the provisions that relate to the functions and role of the supervisory committee. However, the audit committee, like I said, is a board committee, and that the role and functions of the audit committee is to ensure that there's an accountability body in place for the board. So the audit committee reports to is a board committee. So it's not the same. It doesn't carry on the same as the supervisory role, which is more like a watchdog for the sector. Right. So it's more like a watchdog for the sector, meaning that it acts on behalf of the membership, keeping the management accountable. Whereas the audit committee is a board committee that ensures that the board is functioning as it should.
Okay, you also mentioned that regulations are expected to be released regarding the function of the supervisory committee. When is that expected to happen?
Sorry.
You said you were releasing regulations to clarify the function of the supervisory committee, particularly when you have an internal audit function that's working full time.
Okay.
What exactly is that role supposed to be?
Those regulations would be to more or less refine the role of the supervisory committee, because what does the supervisory committee do now? The supervisory committee now is there as a tier or a body that's responsible for keeping the membership informed, not so much to dictate to the board or to dictate to to the board. They more or less meet with the board. I believe quarterly it is. They meet with the board quarterly, and that is only to I don't have the legislation in front of me right now, but you may know better than me your reason for the supervisory's role for meeting with the board on a quarterly basis, but they do not dictate to the board. The supervisory's role is not to dictate to the board. It's just to review the books, and that's it. Not even the records, but more so the books.
The concern
And then
is that
they offer an internal audit function in the event that there's only on an interim level. It's on an interim basis where there's no internal auditor. The supervisory committee would facilitate that process only for that interim period.
see, and that's the problem. The way the legislation is currently written, it seems to be open to interpretation. So as soon as you can close that gap and put in black and white exactly what they should and should not be doing.
It's there in section 86. It's there. Yeah, Stacy, you mind passing it, please?
But it's
The
a good
functions
point
of the-
because
we can look at it.
even though in some of the cooperatives, if not all of them, by default, they've seen to it that the internal audit function with staff.
Mhm.
The legislation said that they only picked up that slack if those who were responsible for it failed to do so. So now you have to
You
hold
can
that,
interpret it that way, but it doesn't specifically say that. and
but you have
that's
to
why
hold,
it's
you have to
open
remove, you have to
interpretation.
make that accountability clear up. Yeah, so that's very good.
So
very
we
good.
need the
Yes.
central bank to close that
Yes.
gap from the regulatory standpoint.
And
Yes, sir.
that's a part of the task, yeah.
Okay, and one more thing. You want to make the decision as far as approving directors to the board moving forward. Exactly at what point through the election process does the central bank plan to get involved?
Pre-election electoral process. So
Okay, so
before
they're
before the
nominating.
engagement, yes.
Okay.
Once the nomination occurs, those names should be submitted to the bank.
Okay. And can you give any kind of estimation on how long it would take to actually vet them and approve them moving forward to the election process?
Not quite, but I would say that it would be within a reasonable time period.
It's a similar process with the commercial banks. So once all documentation has been submitted, and the team is able to review those documents and don't have any further questions or require further documents, then the credit union would receive the feedback on whether this application that was submitted is successful or not.
I guess
But is there a set time?
Yeah, so the
How
time,
far ahead of the AGM should we
Uh-huh.
get them to you so we don't have any?
Oh,
issues
that's what
going into
you're-
the AGM?
yeah, so before,
We,
14 days,
we
yeah.
Good.
All of that would be, yeah.
We definitely, considering that this is a process that we intend to put in place specifically for you, knowing what is expected, we would have to ensure that we accommodate, the timeframes that you would need. So that would be something that we'd have to establish even as a service standard. So that's something that we would look to ensure.
Okay, so I don't know if you actually answered
Mhm.
when is the regulations for the supervisory committee expected to be released?
those are underway, so
Okay.
we will advise the
Maybe-
public
yeah,
and
we need
and
that gap to be closed. Thank you.
okay, thank you too.
Good evening. Ricardo King, Bahamas Law Enforcement. Thank you, Governor, and your team for this industry briefing. I have a concern with reference to the dormant accounts. The qualifying share account is what gives the member ownership in the credit union. We believe that as long as a member has the qualifying shares, his account can go dormant. His accounts cannot go dormant simply because the qualifying shares is not only about transactions. It's about voting. It's about the insurance coverage. It's about being nominated to run for the board. So it gives them ownership in the organization. All right. I see the Act speaks to deposit and any other facility. So I include the qualifying shares in any other facility. If there is a concern that these accounts may go dormant, and it may be taken into our revenue, we have a stopgap measure for that, and that is every member signs a beneficiary. So if the member does die, the beneficiary would get the money. It doesn't stay with the credit union.
Mhm.
If the beneficiaries are not available, then the family is contacted to have the estate probated. So based on that, we would like some consideration to be given to how we address dormant account
Okay.
Going forward.
Okay, I have a question as well. The qualifying share that you referred to, how are those held? Are they held within the deposit account collectively with the client's fund? How are they treated?
They're separate. They're in
They're
the balance
separate.
sheet. They're carried in the equity section of the balance sheet.
Right,
But-
so I don't know if this applies, but I will accede to my colleague, maybe perhaps she can speak to that. I don't know if this provision quite applies to the shares, but maybe somebody else can.
It doesn't apply to the share.
I don't.
Okay. Right, but it is our contention though that if the member has the qualifying shares, then the accounts all of his accounts are still active. Yeah.
And I think that's a very helpful piece of information because inevitably dormant facilities are usually facilities where you even lose the interaction and engagement with the individual. So when we refine administratively what this looks like, it presumes that it is for all intents and purposes dormant. So we could also work on how we define dormancy if you have a very active process of managing, all of those. So that helps.
Yeah. Okay. All right. The other point I wanted to address is capital adequacy. Now, I know it was not stressed in this. However, we have with the credit union where we address capital adequacy based on total asset. In my balance sheet that I could speak for, 30% of my balance sheet is cash equivalent investments. And those investments are in government registered stock. 66% of it is loans, 67%. There's a good portion of those loans that cash secured or have sufficient security. I've been fortunate enough to have a good performance, not so much delinquency. So one of the things we would like the central bank to consider, one is the weighted average or rated risk approach on capital, or to consider looking at our balance sheet and the depth of risk that it carries and possibly adjust that 10% which is applied to total assets.
Okay. Karanda or Sharice?
I mean, this is something we started to look at previously, and it's something that we'll possibly consider. However, given the size of the credit unions, their balance sheet, like this, with respect to the smaller credit unions, it could place a strain on the balance sheet when you risk weight assets. You talk about loans, and typically when we look at the commercial bank's balance sheet, those loans are risk weighted at 100%. And the banks, in particular the domestic banks, their capital requirement is 17%. So you're looking from moving from 10% of total assets, which gives you a little bit more flexibility, to having that flat requirement of 17% that you aren't able to, well, the sector isn't able to achieve at this time, just looking at your balance sheet and what you have been reporting so far in terms of the gearing ratio, capital to total assets.
Okay. All right, so consideration then could be given to possibly looking at the level of risk in the balance sheet. And
calculate the capital adequacy ratio. You look at your capital and over your risk-weighted assets times 100%. So we're looking at it. So cash would be risk-weighted at 0%. Loans, as I mentioned, 100%, depending on certain factors. You see what I'm saying? We're looking at each asset and risk weighting it. And so those are going to be, the denominator is your risk-weighted assets, and the numerator is your capital.
okay, but never mind the fact that a large portion
that you can look at now and see where you as an institution would fall. And then you could compare it to what we have in our capital adequacy regulations now to see where you would fall and to see whether this would be in your best interest based on the size of your balance sheet.
Yes.
Because it's going to be a strain on your capital and obviously also on your lending, which is already strained.
Yes. But never mind the fact that a large portion of my deposits are being held against those loans.
It's still risk. Yeah. that would still be considered in the risk weighting, but you would have to do that calculation yourself and see where you land. And see if what we are asking, for example, the banking sector, that 17%, they exceed that. They're holding way more than that, but they can afford to do that. Yeah.
Size sector, so you want to make sure you're assessing the sector on a proportional basis. So if you're applying something such as the capital framework, that the sector can sustain that and it's not providing an unnecessary requirement to the entire sector. So while individually an institution may assess their capacity, and you're free to do that in accordance with the capital framework, the sector is what we're looking at in terms of how each institution will look at it on a proportional basis. So if you recall this morning, we defined small institutions, and of course, the entire credit union sector would fall within that. And so even within that sector, there are some smaller entities. So you want to make sure that we are considering, from a supervisory point of view, the risk-based proportionality.
I would add to that, when we look at where the sector is now, even if we use a different framework, we would still make a distinction between just doing, the baseline assessment and what the target is, and being mindful of how you gravitate towards the target. So whether your suggestion is more advantageous or less advantageous relative to what you might have in the pearls ratios will matter less relative to whether we are now going to vary the target from what we initially assessed. So I think that's what's important. And in all these cases, we're realistic in terms of recognizing that if the target is different from what we assess, then we have to work towards it. And I think there are, even in the case when the credit union sector looks at what they want to see in terms of their lending environment and outcome, in many cases, you foresee an outcome that looks different than the present. So it'd be similar in terms of how you progress towards it, and not expecting, say, a 12-month or even in some cases a 24-month deadline, depending on the issue. But at least it takes us a lot more, even what you're saying, to looking at things from a risk basis. And the risk basis does clean up a lot of the way one might be looking at things that we probably are not fully doing right now.
Okay, I take your point. But I'd like to say to Ms. Smith, though, is that the bank's balance sheet have a whole lot of other risky stuff besides loans. Credit union balance sheet basically is only loans. So if you took 100% of my loan, my capital requirement would still only be about 7% thereabout.
But you're similar, you're in the same space. So you're similar to the commercial banks where their largest asset component is loans. So with the commercial banks that are grouped with you, the domestic systemically important institutions, their balance sheet, the size is different, right? But the components are the same. Loans, they don't have a lot of investments, and you're looking at more trust companies and investment companies that would have investments and stuff, yeah, as the largest asset component. So you're similar, you operate similar to the banks. You accept deposits, you give loans.
Yes.
Yeah.
And we hold deposits against.
They do the same. And we factor all of this in. Yeah.
Yes. Okay. And the reason why I speak to that is because in a lot of cases, the 10% is basically where we are. Many of the credit unions. So it's razor thin, in my opinion, for me to be able to really take any major risk in lending. So it kind of ties my hand. So that's the reason why I speak here. But I hear what you're saying.
Understood.
So I need to look for another way to address that.
Yeah, yeah.
pushing everybody into stress testing. And so when you
Yeah,
start stress testing
yeah.
based on the risk on your balance sheet,
Yeah.
Yes.
you
Yeah.
can see the capital coming with different levels of threat,
Yeah,
which
yeah. And then,
is a
yeah,
different
yeah.
strategy.
Yes.
Right. And unlike the commercial banks who may have a parent company to rely on to inject capital, the credit unions would have to, revert to the membership to either increase equity shares or, so, yeah.
Okay. All right. My last point is a simple one. You indicate the appointment to various committees, and you speak to the qualifications, which is fine, but you also speak to experience. Would the central bank be at least giving some detail of what the experience that you're looking for? Would it be years? Would it be position? Would it be?
So that is covered in our fit and proper guidelines that was recently issued. The criteria, all of those, the criteria are outlined in those guidelines. So we speak to character, we speak to the financial position of the individual, experience, all of that.
And then
Okay.
the
I
legislation.
believe you're referring to the directorship
Yes.
Yeah.
in particular in terms of what expertise they should have.
Yeah,
Right.
because those,
Right, so we-
those directors are members of.
Are you
those
going to
committees.
require them to have years
many years of
of
experience.
experience to that extent? That is something that.
I believe we use the term recognized.
Mhm.
Not any single individual is assumed to provide all the skills that the board needs. So at the end of the process, you're just making certain that other than the fit and properness of individuals and every other step, that the board has the right cross-section of skills. So it's not expected that everyone comes to the board with the same qualifications on paper, but that the board is constituted in such a way that it has the balance of skills that it needs for its business. So that would be, and so even in those cases, we might say to you, well, we think you need someone on your board that understands technology risk. It's now up to you to find that individual, or maybe depending on your line of operations, that maybe you need someone with some legal background. We don't handpick that individual, but then you can use that to know how you recruit to fill any vacancies that you have. So that's the way beyond fit and proper that the regulator starts to look at, the makeup of the board.
Okay, thank you.
And I would add as well, we use terms like a recognized expert, or when we use terms like expert, that would speak to how learned the person would be as well.
Yes, good afternoon, all,
Afternoon.
Governor, persons in their proper protocol being established. I'm Omar Neely. I'm from the Bahamas Law Enforcement Cooperative Credit Union as well. I wanted to say something with respect to the makeup of the board. We talked about the audit committee being a board committee, or having the audit committee come out of the board. Is that what we're moving into?
Yes.
We also mentioned the criteria or the experience that the central bank would want to pre-qualify persons who would be joining those boards. I wanted to put in the atmosphere, the practice, and based on the 2015 Act, all of the committees that are set by the board, there are technocrats on those boards. If I could give you a clear guideline, the board members are 7 members, and also on that, not a board member, but the manager also helps to guide that board. On the supervisory committee, they are guided also by the internal auditor. All of the committees that we have, board committees, let's say the HR committee, they'll have someone who's a technical expert from that credit union, usually that serves as a part to assist in guiding that board, those directors. The whole idea, if I'm wrong, someone say to me, of corporate governance is that the board members themselves are not technocrats. They're for the most part laypersons who will take the advice. They're policymakers, the board members, based on the advice of the management and the technocrats that exist in that entity, they will advise, they will represent the membership who are the owners. So the board is a small portion elected by the members to represent the members. They're not the attorneys, they're not the accountants, they're not the internal auditors, because number one, first, don't forget this now, board members are volunteers. So when we look at the expertise and criteria that the central bank will require from certain boards, we have to remember that, hey, these people are not being paid for these positions. They are policymakers and they're being guided, ideally, by the technocrats that exist to do the same. So I just wanted to put that in the atmosphere so that we can all be on the same page of who these persons are leading these boards.
Mhm. I understand that you want to maintain the member-driven ethos of the credit union. That's respected. However, you know, the financial sector is becoming more complex and it requires the more technical or adequate technical expertise. That's something that we found is lacking in the credit union space. And so we just want to ensure that there's sufficient competency, and we want to achieve more sound decision making at that level. So in keeping with that, I'll also say that if you look at the makeup of those boards, you would see that we are only asking for 1 or 2 experts. So there's still a hybrid, there's still a fusion of the membership with technocrats. That's not being taken away. You know, you may have members who are already technocrats. So there's no bar against those persons participating. So I hope that adds some value to
Yeah,
what it
if
is
I
that you're
can,
proposing.
yeah,
Sure, you can.
if I can add, I hear what you're saying, and I think just a matter of appropriate governance, I think we want to be sure that, you know, the directors nonetheless are directors, and they should be able to ensure that they're comfortable with what is being said to them. To the extent that you have a technocrat there, if you have another person who can speak that language, they understand that and they could say whether they agree or disagree, as opposed to, you know, if you have someone with that type level of expertise there, you have a even more sound basis for carrying out what is needed to be done. So I you know, I don't take away from, you know, I guess the methodology that's currently being used, but I think we're just trying to strengthen what is happening in the governance of the sector, allowing for someone to be able to you know, to challenge what may be coming to them rather than just accepting it.
Certainly,
You know? So I think that's the main reason for what.
I agree with what you're saying, and I certainly agree that there should be some criteria with which these board members have to stand to or to come up to. I just wanted to put that in the atmosphere, exactly how.
And I think that's fully appreciated. I think the point here is really
You wouldn't want a random person off the street
no
sitting at the board. They can't understand what the manager has to
and
say.
we never, the central bank, well, again, remember now we're saying that we would be looking to approve these persons too, right?
Right.
So, right. So, and there are certain guidelines that would be put in place. So I think at the end of the day, it's not to take away from, it's to add to. So we're trying to strengthen the governance, and to strengthen the governance, we want to put persons in place who can actually challenge what may be being given to them, you know, and bring some stronger, you know, strengthen.
If I can add one more comment with respect to the board committee, particularly the audit board committee. I want to put in the atmosphere once again, the term separation of duties. When I'm a board member, when we sit at the board, we make decisions, reference the policies based on advice from the manager. I'll say I'm a relatively qualified person myself. I wouldn't toot my own horn today, you know. But we don't make those policies in the presence of the supervisory committee. They're independent. So once you would have made that policy and you'll see things start to unfold with respect to a new product or some risk or something that we did new, the supervisory committee, the internal audit function, the watchdogs, they will then review those things and say, Mr. Neely, you all ain't making no sense. You all need to do this, do that, do it, etc., based on our observation. When we have the auditor on the committee making the decision as well, it gives that person a little less of a independence in terms of scrutinizing the decisions or the policies that are being made.
And I maybe I'm misunderstanding what you're,
I'm making
Speaking
particular
to
reference to the proposed
audit
audit committee
right, but I don't.
coming out of the board.
Right, but the audit committee, I think, as we're talking about, is not necessarily inclusive of an auditor.
I understand,
Of the
understand you.
Right, so the independence is that the person on the audit committee is independent of the management and the staff. That's the independence. That person is part of the board and they're looking at it from a more, as, you know, from a board level, the audit aspects of
So
it.
this
And
person, these two persons, I think you mentioned two persons for the audit committee persons, experts. Would they also sit on the board?
At least one, right? I don't know, both? Yep, yes. And that's consistent, that exists. That
Okay,
exists now within organizations, audit committees of boards. That exists. That's not a new, you know, a new
You can also,
committee.
you have committee,
Hmm?
board members must be on the committee.
Sorry?
But the committees,
Sorry.
board members must be on these committees, but the committees can also recruit non-board members. So, and that way they ensure that they have the right composition, but they also ensure that it isn't a committee that's 100% of just the board advising itself. So
right.
it is also an opportunity for the board to get external attachments to help advise it.
Okay,
So
okay.
it's a mixture,
Okay,
typically.
so I'll stand by.
Carl, but just reminding me that the World Council also supports and defines the audit committee.
As a part of the board?
Mhm.
That's my question, thanks.
You can take this one.
In the past, when we look at audit committees, it's the same committee on a board. That's like the HR committee, the investment committee. They would have two board members, and they would have like the financial controller or the risk person. They will make up that committee. And I think that's what you are talking about at World Council, but it's nothing to do with an elected committee, like the supervisory, the credit, and the board. Yeah, and I think that's how, and that's how it works. But it's not like all of that.
But in modern practice, those committees aren't just board members, management. They pull people from outside of the organization entirely.
Executive.
So that
Yeah, two boards. And you have a credit risk person, and now just recently, we're having somebody from the outside coming in on a contractual basis to work with that committee. So the credit unions, we are being compliant, we are trying, so, and you know, and it will work. So I know. Right, and that's what we are working on.
Have it
Because
formalized. in
Because if you would
legislation.
note that we are now having a credit union training institute where all of these things will be put into place and we'll have it across the board. So we are working towards all of that.
That is good to
'Cause we
hear,
don't want to
Madam
lose
President.
another credit union.
Thank you. Thank you, Mr. Neely and Ms. Delaveau. Any further questions from the floor?
Okay, so if there's nothing else from the floor, we'll indicate, highlight some of the comments and questions from the chat. And the first is just a comment that the nomination committee needs to remain independent of the board. Some of the comments I think would have been expressed by members in the room. We note that you're proposing having directors to serve on a number of committees. Are you mindful, again, of that the board members are paid a stipend, which is not a paid position? So I don't know if that's something you would respond to, or if it's just a statement, but it's just saying that, yeah, it's more so of a, just if you're aware that it's not,
Not even a stipend.
yeah, it does align with what he was saying.
Is a stipend or there's?
They are paid a stipend, but it's not a paid position.
Okay, just like
not
any other
paid,
board, I
yeah.
imagine, Governor, they typically.
No, it's recognized, and maybe the point that they're getting at is that this is not a competitive compensation, that's understood. So we anticipate that, you know, cooperatives will continue to benefit from the volunteer spirit of people who assist them. You know, one of the thing that we also need to discuss with the sector is the flexibility in terms of how you recruit persons who assist you. And I think in those cases, you need not be constrained just to the membership. If you can co-opt other people to sit along with the board and committees and provide input, and the volunteer spirit remains strong, then we should have a conversation as to how you can get access to those individuals.
So another comment is that the consultation paper stated that the supervisory committee will remain unchanged. However, section 13 of the draft bill states that the word supervisory would be deleted and substituted by the word audit.
Okay, that must have been an oversight because it was a very late change in the game. So we will correct that. Thank you for highlighting that for us.
Another.
Let's be clear.
Mhm.
So you wouldn't be deleting supervisory?
No, supervisory committee will remain as a separate committee from the audit committee.
Okay, just highlighting that the supervisory committee is considered a watchdog and is independently appointed. So they're noting that if you're not on the board, you can still call a meeting. If you remove the independence, you may remove the independence if you have a member of a board on that committee.
On the supervisory committee?
Yeah.
Oh, that's not the case. The composition will remain as is. Yes, supervisory committee, the composition will remain as is. Everything relative to the supervisory committee will remain as is.
Okay.
Doesn't realize that the supervisory committee has a lot of power. And I think that's what we have. What I was saying was that a lot of persons, they don't realize that the supervisory committee, they have a lot of power. If you look, I know you were saying that they just read and do all of this, but if they do what they're supposed to be doing, they are very powerful. They could remove boards. They could call special call meetings to the AGM because they are elected body. So that's what we have to look at, is strengthening and like across the board for our supervisory committee members.
There's a next, I guess, series of questions. Will there be an ability to have board members who are not members of the credit union or have minimal holdings to allow for more diverse boards? Also, some supervisory committees by election can consist of members only from one particular island, whether it's New Providence or Freeport. Oh, that's posed as a question, but are there any provisions on the background or diversity of supervisory or audit committee members?
I would say that the industry would be encouraged to advocate, you know, for more diversity in terms of how they staff these bodies. Definitely, we're very open to, you know, how that would look.
Co-op persons serve as consultants who are and have been utilized by credit unions. Why change this? Co-op persons serve as consultants who are and have been utilized by credit unions. Why change this? Is that this isn't being changed?
Yeah, I don't think we're attempting to change anything. This is just working to, as I mentioned before, add and enhance. So to the extent that that exists, I think we're not against that. We're just advocating for additional, expertise and support. Yeah, and I think if I may, Mr. Ella will indicate, certain things are happening, and I think we appreciate it that certain things are happening. What we're attempting to do is formalize that across the board so that, it's evident and apparent for, the sector as a whole, right? So.
Okay. They're just indicating that for the same individual, that for clarity, persons who are not members of credit unions can be utilized as consultants already. Yeah. So yes, that's happening and that's encouraged. Okay, so we also have a comment from our Facebook viewers that has indicated, I was late joining, but from what I'm listening to, the central bank appears to be a little harsh, being harsh on credit unions. So so they're just expressing their concerns about the regulations and I guess the impact on credit unions.
Well, that's not the intention.
Yeah.
Growing pains.
Yeah, it's not
Growing
supposed to.
pains come about, but I can ensure that when everything comes into play, into full motion, you would appreciate some of these changes and enhancements that have been made to the legislation.
Yeah, so.
I don't know if anyone else has any questions for us. If you don't at this time.
I just wanted to comment.
Sorry?
On that last point that was raised.
Mhm.
Just to say that the proposed amendments are, as you stated earlier during your presentation, to strengthen the sector. So it's not intended to have any adverse implications on the sector. And just as I mentioned earlier, credit unions operate similar to banks. And so our role as the regulator is to ensure safety and soundness. And depositors place funds with the credit union sector. So they would want to be comfortable knowing that we have strengthened our supervision of the sector. So that's the aim. Depositors funds, yeah, protection of depositors funds. Thanks, Carl. That's it for me.
Okay, so the final point from the Teachers and Salaried Workers Cooperative Union, if the supervisory committee remains unchanged, why remove them from the act?
Okay, so I believe we clarified that already, but just in case that person is late joining us, we do not intend to disturb supervisory committees, the provisions relating to those at all. And the only, I think it was section or clause 13 that may have suggested that we were removing the term or replacing it. That is an error and we intend to correct that.
Another question coming in, are you aware that from an international perspective, cooperations are supposed to be tax exempt? So why the move to charge VAT?
Governor?
Well, it's not all businesses in the Bahamas exempt from profit tax. So if that's what the individual is referring to, then that's universally the case. In the case of the value-added tax, it's really dealing with the instances in which they are encountering that in their inputs to the operation, and making certain that there's clarity in terms of how the VAT is administered. I think there's still some aspects of government taxes where in transactions specific to the operations of credit unions that the taxes are still not applicable. So those cases do not go away. It's more a reference to value-added tax in the context where these entities are procuring goods and services from the same providers as the general public.
Because right now we only pay.
Sorry, it's just so that people online can hear you.
No, I just mentioned that was something that we fought for, having VAT removed from our members. Not necessarily no place else.
So this is VAT in relation to the fees and charges that you assess
Yeah,
on
but
your
only,
members.
the only thing we pay VAT on now is our on our investment properties, nothing else. And so I don't see how that should be taken back from us.
We're looking at, I mean, there's more clarity that can be brought to this, but the way the provisions are written in the Cooperative Credit Union Act,
Mhm.
and they need to be expressed, I think, cleaner, because so that you remove any confusion as to whether if you're purchasing the office supplies or you're paying your utilities bill and or some of those other instances, whether the same applies. You're referring to value-added tax in the context of real estate. That's basically replacing what used to be the stamp tax. So I could understand if that provision was intentionally kept. And those are examples where I think the clarity, could be better. And some of the clarity might even be expressed in the Value Added Tax Act to help as well.
I think it's just on, everything that's the members, the products and services that we get. Yeah, no, I thought that's what y'all wanted to take away too.
Okay, I believe that brings us to the conclusion of the segment. Thank you once again for those tuned in virtually and to all of you in present. But before I'm concluding my segment and I'm inviting our Deputy Inspector to come with closing remarks. But I'd also like to remind you that the consultation period is open until the 31st of October. So you are welcome to submit any further questions or comments that you may have during that period. Thank you.
So as we wrap up the day, it's worth mentioning some of the key highlights of what was shared today on the proposed legislative reforms without hopefully not belaboring the session too much. From our morning session, we were made aware of the introduction and intended rollout of agency banking to aid in central banks' financial inclusion initiatives, allowing banks to appoint agents, but having them remain accountable and liable to ensure consumer protection. We also noted updates proposed to the Central Bank Act, allowing for two-tier penalty system, notably introducing the small service financial institution definition, which in essence allows for some measure of proportionality in the penalty framework. We will also see some clarification related to enforcement language within the Act, and of significance is the proposal of separate penalties for late and erroneous filings to introduce a flat penalty charge for erroneous filing rather than the per diem charge. This I know is a welcome change for some entities. We would also have been advised of the various changes proposed to the protection of depositors AML regulations, bringing the credit unions under the ambit of the broader protection framework and continuing to foster strong customer and consumer protection. In relation to payment service providers, it is proposed that MTBs will now be governed under the Payment Regulatory Framework rather than under the Banks and Trust Companies Regulation Act. Our legal colleagues also spoke in some detail about additional enhancements to the resolution framework, in particular noting the inclusion of the credit union sector in the resolution regime. Also highlighted were the proposed reforms to strengthen the Deposit Insurance Corporation's powers to support resolution actions and facilitate faster and smoother payout processes should the need arise. In this afternoon session, we focused primarily on the credit union sector and the proposed amendment primarily addressing enhancing the supervisory framework around credit unions and the sector's governance frameworks. As indicated throughout the presentations today, we do value the comments to the proposed reforms, and we look forward to your feedback by October 31st. As was pointed out, and as is customary, we expect to publish the comments and queries received along with central bank responses. It is important to note that when making proposals for legislative amendments or reform, the central bank does not take such actions lightly. We do so after much thought and in the best interest of the financial industry within the Bahamas, in keeping with our mandate, with one of our mandates, to ensure a safe, sound, and compliant financial system. At the same time, taking into account consultation and feedback received. So, we do thank you for partnering with us in this undertaking. Specifically, we thank you for attending today and for your participation. And we look forward to hearing back from you very soon. I thank you.